For me, there are only two markets in the world, US and India.
You don't look at China?
I don't trust the Chinese government. India is 10x of what they were at 2008 lows. China is still there. Why? Lack of trust.
Your fund was able to get 128% returns in just 1 year. Compared to the Nifty, which has given only 29% returns. How were you able to get these kind of returns?
When as a retail you don't understand a particular company, you can always bite on tips.
What about these new age internet companies like Swiggy, Zomato, Zepto? These companies which the youth really uses a lot, has become so addictive that we use it almost every single day. How do you look at these kind of sectors?
I think HUL should be more afraid of Zepto or Zomato than it should be afraid of declining incomes of Indian consumers.
A lot of people think that if I copy Warren Buffett or if I copy Rakesh Jhunjhunwala's investing strategy, how can I go wrong?
The problem is that I've learned this by reading Mukesh Ambani, that let's have our food when it's warm. Neither it's cold nor it's hot. So if you like a particular company, you think it's expensive, it's okay to wait it out. Never ever jump into a company just because the sector is good.
Based on your hypothesis, what do you think is going to happen in the next 3 years? What are those sectors that will benefit really well?
In today's episode of the 1% Club show, we sit down with Anirudh Garg, managing partner at INVasset.
With over 15 years of stock market experience, Anirudh leads 500 crore in proprietary investments and manages another 500 crore in PMS portfolios, blending deep conviction with data-driven investing. We dive into how a 25-year-old can start with mutual funds, what sectors are set to boom in the next 3 years, why China isn't a value market, and how India is his next big bet.
All right. So Anirudh, thank you so much for coming on our show.
Thank you, Sharan. Thank you for having me. It's a pleasure.
Anirudh, let's just start with a bang. My first question to you is, your fund was able to get 128% returns in just 1 year. Compared to the Nifty, which has given only 29% returns. That is 4 times more than what the Nifty has given. How were you able to get these kind of returns in your fund? Can you please explain to us?
This is something I talk to my clients always whenever they come focusing on that 128% return, that whenever you're choosing a fund manager or a mutual fund to invest in, look at least 3 years, or if the fund has history, at least 5 years of what the performance has been. Sharan, I've always focused that my return targets should be very, very clear to me. I believe Nifty is a 12 to 14% compounder. I want to do 1.5 to 2x. That is like 18 to 28%. If the Nifty did 26, so my range becomes 40 to 50. I've done 44. I'm happy with it.
And that puts you in the number 1 rank of all the funds in India, right?
Yes, it puts us among the top league. Yes. And how we have been able to do it, I think the only reason that I feel that we've been able to do it is because of discipline and the quant that we follow.
So based on your hypothesis, what do you think is going to happen in the next 3 years? What are those sectors that will benefit really well?
As I told you, we are seeing a lot of changes happening in the stock market sector. We are seeing a lot of changes happening.
When you mean stock market sector, what do you mean?
Stock market intermediaries like an exchange, depository, somewhere, something like that. So
the infrastructure behind the stock market, that will benefit.
The stock market infrastructure sector, to be precise.
Okay.
Very good wealth managers, AMC companies, they look good to me.
Okay.
See, then something about, if you've read go and read the US Biosecure Act. It's available, and if you read it fully, it's a little lengthy thing. But if you read it, you will realize that how desperately US wants its pharmaceutical production to move out, not entirely out, but have an alternate to the pharmaceutical production from China.
So right now, US pharmaceutical comes from China.
Majority of the entire world comes from China.
For the pharmaceuticals,
everything and whatever we are consuming, be it pharmaceuticals or anything, it's all coming from China. The Mahindra cars that we like today, those new cars that have come, the batteries are coming from BYD.
Okay.
Yeah? So somewhere we have to. So if you read the US Biosecure Act, you will see that they desperately want. They've listed companies by name. This is the company that we don't want the production to come from. So desperate. A country would never do that. So we are finding relative changes here. Pharma has been a sector which has been in India for the last 3 decades. We have been leaders in generics throughout the world. Okay, how we helped the world with vaccines during COVID. So the first person who will be able to take advantage of China plus one will be the pharmaceutical industry. Why? Because they have their presence on ground.
Yeah. So we already have the infrastructure set up.
Yes, we have the presence on ground in India. We have the presence on the ground in the US. We know how the Indian authorities work. We know how the US authorities work. And then when the opportunity is there, we'll be able to take advantage of this.
Got it. So that's the second one, pharmaceutical.
Yes.
What else?
Somewhere we are seeing that a lot of value is being created. See, last capex run that was there, anything and everything was going up. Why? Because there was too much valuation gap. The capex stocks were very, very cheap in India back in 2020.
When you mean capex stocks, what do you mean? Give me examples.
Railways, defense, infrastructure, power,
Got it.
all these stocks. Everything went up. Now, the leaders among them who are doing real businesses on ground and will be able to translate their order books into earnings over the next few years, these will be the people that will make money from here, and now you're getting them at a discount. Yeah, apart from this, there are a few sectors, say, when the government lost the election, no, they didn't lose the election, but in their expectations, they really lost. They were not able to
They
get
wanted
the,
400 plus seats, but they got less.
Yes. So somewhere the focus shifted from capex to socialist measures as well. Yeah. So a lot of focus on farmers. So I believe there is a good scope in the fertilizer sector. There is some good scope in the seeds sector, and somewhere the new age consumption, something like fast moving fashion or delivery of food or groceries to your home. I believe these sectors are, should be the flavor for the next few years, because we are seeing earnings visibility in them. We are not seeing any problem going forward.
So right now you mentioned that you're managing 1,000 crores. 500 crores is investors' money, 500 crores is your personal money. What is the sector allocation? Do you know the percentage in every sector that you've currently invested in?
Yeah, so around, I would say, we'll be around 20% in pharmaceuticals. Okay, we like the hospital industry a lot, hotel industry a lot. So all these hospitals and hotels would be around 20%, and then capex value would be around 20%, and then stock market would be around 15%. And then the smaller sectors would be around 5. So we keep a very, very well diversified portfolio. Just where we see newer relative changes emerging, we give a little more than what we would generally give to a company.
So when an investor comes to you, right? Let's say I'm a HNI investor. I'm ready to give you 50 lakhs. Check. Now I will also look at mutual funds.
Yeah.
Now there are a lot of mutual funds which have given 20-22% CAGR as well. Now I'm coming to you you're a PMS, right? So I'm coming to you to be better than mutual funds. So from an investor expectation, what expectation do HNI investors typically have? Because a mutual fund is giving 22% and I'm coming to you for getting more than that. So what do they compare you with? Generally?
When we say 22, when you're saying 22, for that period, R is 44. If you look at the last 5 years. Yeah. So generally how I see it, because I've been an investor, how I see it is Nifty 12 to 14% product. A good mutual fund will give you 16. I want to do 18 to 28.
Got it. So you want to be like 4 to 5% extra than the good mutual fund.
Yeah, post returns, post expenses, post everything. I want to be a 18 to, and it's a very, very good zone to be in. If I'm able to do it for the next 20 years, Sharan, I'll be the happiest person.
So let's do some math. So if I am investing 1 lakh rupees monthly SIP, and if you give me 24% returns for the next 30 years, I will have 356 crores.
Yeah.
Right?
Okay.
Interesting.
And you have to, you have to account for inflation.
Right.
Yeah, you have to account for inflation. We'll have a 4 to 6% inflation as well. And then you have to account for taxes as well.
I mean, even if I do all that, I'll still have 100 crores. So it's fine.
Yeah. So you have to look at, the 100 crores 30 years down the line will not be of the same. Of course, we have accounted for inflation.
We have accounted for inflation.
So it is about the snowballing effect. You have to make sure that the snowball that you have set rolling, just do not disturb it. Power
is there like a threshold that you observe?
Is the first wonder of the world. Rest 7, I don't care about. It is the first wonder of the world. People say it's the 8th wonder. I believe it's the first wonder. Because over time, Sharan, when I joined, I used to think that if I have 10 crore rupees, I'll be very, very happy. Yeah. That was the expectation I had set for myself without factoring in the power of compounding.
Okay.
Power of compounding, you are getting those. There have been months where we get that 10 crore rupees now.
Yeah. In 1 month you can make 10 crores. There have been months like that.
That is what power of compounding does. Now you are making, let's do simple mathematics. 1 crore rupee invested at 18% for the next 30 years.
Can you do 20?
Yeah, let's do 20.
Okay. 20.
Yeah.
So it's coming to 19.5 crores.
Yeah. How much did you make in the 19th to 20th year?
I can say from the 18th to 20th.
Okay.
18th year, it was 14.5 crores.
And
20th year, it became 19.5 crores.
yeah, so you did 5 crores. And how much did you do in the first 10 years? How much was it?
9 years, it was around 3.8 CR.
See, so you did in the last 2 years 1.5 times of what you did in the first 10 years. So this is the power of compounding. You know, Warren Buffett was not a billionaire till he turned 50. And all the wealth that we see today has been made after that. So you have to think 30 years down the line. First of all, what is the strategy that can hold that much amount? And what is the discipline that I need so that I do not disturb this compounding that is happening? This snowball effect, that book by that Warren Buffett, the psychologist, go and read it. It's very, very important. You know, we are all concerned with short term. And we as Indians, what will we do with that short term? We don't know how to spend also. You know, we are not those spendthrifts like the West. We have a culture of saving, but everybody wants quick money. So let's focus more on the CAGR, on the power of compounding, and not on the quick money, because it's of no use, because we are all going to turn 60. And that is where I think we'll see what a real wealth we have generated over what we have. We should enjoy our wealth. I'm a great believer that we should. But when it comes to making money, we should believe in the power of compounding.
Got it. So you mentioned your favorite sectors as pharma, high capex companies like L&T, and then you also mentioned about the stock market infrastructure companies. That is what's majorly there in your current portfolio of 1,000 crores. But what about sectors like data centers, right? Data centers are required for the AI world that we're living in.
Yeah.
Or maybe in the electric vehicle world that we're living in, battery technology, semiconductor industry. Don't you see those as also sectors which can grow fast in the next 3 years?
I think they are not very, very credible companies in these sectors right now.
In India?
5 years down the line, there will be. Right now, we don't have many.
In India, you're saying?
Yeah. I think I've learned this by reading Mukesh Ambani and his interviews, that let's have our food when it's warm. Neither it's cold nor it's hot. You will never see Reliance going into a sector when it's too hot.
Correct.
It'll wait for it to get warm and then maybe get into
Then
it.
acquire
And neither
it.
into the ones which are too cold. Yeah. So let's wait it out. There is ample time. Stock markets are not going anywhere. We don't have to jump in the theme which everybody thinks is a hot favorite. Yeah. So we'll get companies from time to time and then opportunities in the market. This is the beauty of the market. Good companies often gets mispriced here. And then if you have your list right and you have those systems in place, you will be able to pick them in a better way whenever the crashes come. So if you like a particular company, you think it's expensive, it's okay to wait it out. Never ever jump into a company just because the sector is looking hot.
So right now you're saying the sectors that I just spoke about, which is EV and data centers, are really hot right now. Yeah. So you want to wait until until some good credible companies emerge for you to be comfortable enough to invest in the sector.
I think they are the future for sure. Some very wonderful companies we'll see in the next 1 decade. But right now we aren't seeing much.
Got it.
I think Ather has the capability. For me, Ather is the best run two-wheeler EV company in India.
What about these new age internet companies like Swiggy, Zomato, these Zepto, these companies which the youth really uses a lot, and it has become so addictive that we use it almost every single day. How do you look at these kind of sectors, these kind of companies?
I think wonderful businesses.
Yeah.
Very, very good business. Something at the end, somebody in India did think out of the box and created something. And I think they're changing the way of FMCG. I think HUL should be more afraid of Zepto or Zomato than it should be afraid of declining incomes of Indian consumer. Because you will buy what they'll show you.
Correct.
Yeah.
Correct. And eventually these marketplace companies can launch their own brands.
Very, very good margins also. And
Right.
it's very, very now it has come to a level where, today I wanted to buy a nail cutter. Yeah. The same nail cutter was on Zepto for $180. And I went for a haircut and there was a shop there. I thought, let's buy from here. I've never been to a shop in the last 1 year. And that same company nail cutter was for $130. So 50 rupees they're earning more, and that shopkeeper must be earning something as well.
Correct.
A good margin he or she will be earning. So margins here, with the comfort that they are providing, it's good.
Correct.
And with the demography we have, these companies have a very, very big advantage. Yeah. So I live in Dubai right now. When you order something in food in Dubai, it takes around 45 minutes to 1 hour.
Yeah, it's not
the
good.
food is spoiled.
It's not good.
Here in India, it's there within 20 minutes, 25 minutes. You have a 15 minutes eats also from Zomato now.
Correct.
So with the level of population we have and the employment that they are generating, I think it's a win-win situation for everyone. Just take care the one best way. When as a retail you don't understand a particular company or you don't want to, sometimes it's also okay that you don't want to. You can always buy it on dips. Yeah. Suppose you want to say, I have a portfolio of 1 crore and I want to buy Zomato worth 4%. Okay. Buy 1% this time. A crash has come. Next time, if it is, according to Dow theory, it is on a higher base. Buy 1 again. Then keep on adding. These companies are not going anywhere. So that is what I read a article about how somebody made a lot of money in companies like Amazon. Yeah, because the Amazon run that was there from 2008 to 2020.
The first 19 years it was loss making, right?
Yeah. Post 2008, a lot of people bought on dips. Generally, a lot of these companies have a 30-35% dip. So whenever there is a 35% dip, allocate a bit more. What you can do is you can, jaise बोला, sip karo whenever there is a crash. Yeah. You don't need to focus a lot on how they will make money, how things will play out. Because when things will play out, stock market, which discounts the future, will already have everything factored in the price.
Understood. So now let's look at outside India, right? Now you as a PMS fund manager, I wanted to understand, do you look at opportunities outside India or you stick only inside India from an investment point of view?
So for me, currently, there are only 2 markets in the world.
Okay.
That is what I've researched.
What are they?
US and India.
You don't look at China?
No, I don't look at China. I think where trust is not there, there is no contractual relationship that can happen.
Okay. What do you mean trust is not there?
I don't trust the Chinese government.
Okay.
They can do anything. रात को अगर एक चीज बोल दिया तो you cannot take them to courts, right?
Right.
Yeah. So I don't think stock markets in China will ever flourish.
Okay.
Yeah. See, China, India is 10x of what they were at 2008 lows.
Okay.
China is still there. As a economy, has China not done well since 2008?
It has.
It has, right?
But the stock market has not reflected it.
Why?
Why?
Lack of trust. Where there will be lack of trust, there will be no stock market. You'll never see stock markets excel or do wonders in communist governments.
Okay.
Yeah. So half of the world is gone. Yeah. So that's how I believe. I'll never invest in China.
So India and US is all you look at.
India is in US. Why? Because firstly, both these countries. Firstly, I look at a democracy. Second, I look at demography. Second thing that I need is population.
Okay.
If there is no population, there is very difficult chances of growth. Yeah. US has a considerable population. 40 crore people. India 150 crore people. They pass in the population version as well.
And Europe, I think most people have just written off for future growth in terms of compared to these countries. No population.
No population.
Right.
And then among population, young population. Yeah. US I like. Why? Because it attracts a lot of meritocracy.
Yeah.
They have a tendency to attract meritocracy a lot, the US guys. So these two companies...
Basically, the smartest young people from all over the world migrate to US.
Yes. They provide that condition,
Right.
You have to provide those conditions.
So that's a macro trend that you like.
Yeah. So demography, that is why I like these two countries, US and India.
So just particularly in last year, if Nifty has given 29% and you were giving 128%, maybe can you talk about some few investing examples which really helped you get 4x of Nifty?
So see, what worked for us was that we focus on relative change a lot. You will hear this term many times in our conversation today because my entire focus is on relative change. By relative change, Sharan, I mean an advantage that a company has today that it did not have earlier, or a sector or a group has today that it did not have earlier. Some tailwinds working for it. And when you club it with the bias, which is there in the market, bias leads to very good valuations. You get bias, the company that people are holding bias against at extremely good valuations. That is what worked for us, both the things. So in the last 20 years, highest ever capex allocation, a government is going into an election year, which makes the intent very, very clear that we are here for the long run and we want to build something for the future. And along with it, the public sector companies were hated. Let me use that word, hated. That time, nobody was buying public sectors. And the last 2 years, if we see, the public sectors have been the majority of wealth creators. So, to answer your question, what worked for us was first relative change, and secondly, the bias which led us to enter these companies at better valuations.
Got it. So, the strategies that you follow, Anirudh, for me to sort of get a benefit of it, I need to invest minimum 50 lakhs, right? That's what the structure of a PMS is.
Yeah.
Now, for most people watching over here might not be able to put 50 lakhs of their money in just one fund. Neither should they. If they have just 50 lakhs, they should not put entire 50 lakhs in one fund, right?
Absolutely.
PMS is typically recommended for people who have at least 2.5 crore worth of liquid net worth. So for people who don't have that kind of liquidity, how would you advise them to invest in the market? So maybe you can talk about your investing philosophy on how to invest for the long term, because even on a 5-year basis, you gotten a 44% CAGR. That is phenomenal, right? Because if I look at some calculations here, if I do a 1 lakh rupees monthly SIP, and if I do it at a 44% CAGR for 5 years, that ends up becoming 1.6 CR, right? So what is your mantra for investing for the long term for retail investors?
See, for retail investors, I would say, firstly, there is a myth that retail investors have that I do not have the required capital, so I have to trade. I have to take leverage. So first of all, do not take leverage in the market. And secondly,
when you mean leverage, you mean taking a loan?
Taking a loan or taking bets and futures and options, the derivatives and stuff. So I would advise not to do that, firstly, because I've seen a lot of retail investors, a lot of the early starters being caught up in that trap and not able to exit it properly and then losing faith in the market. Secondly, I would say that mutual funds are one of the best. They are actually one of the best products out there. You have the very best minds of India. And then, at a very, very nominal fee. The expense ratios in Indian mutual funds are not very high. You can even go in for index ones. Now, to answer your question, from what I can understand, how do they do it by themselves? First of all, I would say, Sharan, investing is something which requires a lot of hard work. It's very easy to go click a button and buy, and then, follow some tips and buy, and then follow a channel and buy.
Yeah.
But that doesn't work in the long run. Yeah.
Okay.
Ultimately, you need to have your own mantra, your own philosophy, and ultimately,
can you deep dive on it? Why does it not work if I copy somebody else? Like a lot of people think that if I copy Warren Buffett's investing strategy, or if I copy Rakesh Jhunjhunwala's investing strategy, how can I go wrong? Because I'm exactly copying them. So what is the problem in copying other people?
the problem is that your psychology has to match with the investment style. For example, Mr. Late Rakesh Jhunjhunwala, I have deep respects from him, but somewhere where he can manage a leverage trade, okay, even if you know he's doing it, maybe your greed and fear would set in, and then you will not be able to live up with the trade the way he will. Maybe Warren Buffett can sit with a particular stock not performing for 10 years, but will you be able to do it? That is what you have to answer when you are following someone, okay? And then a lot of times, how good are you at copying? You know, it requires a lot of intellect as well when you're copying. The person is able to change. Are you getting that data properly? Yeah. And then there are better options available, better alternates available. You can invest in a mutual fund at such a low expense ratio. Then why follow somebody else and copy it? Now comes a point where people want to go into investing. They want to make it a career. They want to put in good time, good effort into it. So I would say that for what I've learned, stock market is a school where fees is very, very high. Okay. You have to give in there are losses that you will make, and they'll be, I have got the best out of me when I have been stuck in a loss.
Okay. Yeah? Can you give an example?
Back in 2008, when I joined my firm in 2006, in 2008, 50% of my net worth was lost.
Okay.
Yeah. So I realized I didn't know anything about the market much. And I
How old were you?
I joined post-college, I was 18, 19 or something like that.
Okay.
Yeah. So what one has to ensure is that all the fees that you pay as losses, as a lot of tensions that you get when markets go bust and there is bigger corrections in the market, that learnings will make I would say chart your journey going into the future. My experience, firstly, something that I would want all my younger ones, that I advise my daughter, that I advise my younger brother to do. Firstly, you should always develop a strategy through which you can live the downturns.
Got it. So let us take the example of a person who is earning 1 lakh rupees a month and is able to save 30,000 rupees a month towards their investments. What investment strategies would they follow? Because this is the majority of the people watching this podcast.
Okay. So I think SIPs is the way forward. SIPs is the way forward. If somebody is younger, as you said, you can go in for, say, more funds like small caps and mid cap oriented funds, or a multi cap oriented strategy, and not go in for large caps.
But how do you pick the right funds? Because there are 4,000 mutual funds in India, right?
I think the best way is to follow the fund manager, not the fund.
Follow the fund manager.
Yeah.
Okay.
Listen to the fund manager, and if you think that the psychology matches, if you can stay with him for a longer period of time, then you should choose whatever the fund manager is managing. And among that, if you're a younger investor, choose a little risky one, because you can afford risks earlier in life. And if you are someone at a retirement age, so you choose fund which is more balanced, a fund which is the drawdowns are lesser. The fund manager is talking more about capital protection than capital growth. See, wherever the returns will be higher, okay, the drawdowns will be higher. You have to keep that in mind. You cannot have the best of both the worlds.
Right.
So somewhere you have to realize what the drawdowns are, and you should clearly ask your fund managers that, tell me what my drawdown is. What is the probable drawdowns? Tell me a history about all the drawdowns that you have had.
But I can't talk to the fund manager. No?
But you can get the NAVs.
I can get the data and look at the fund's performance.
Yeah.
See how the drawdowns. Drawdown meaning the maximum drop in the value in a single year.
From the highest.
Yeah. See how it has been in the last 10 years.
Yeah.
And see if I'm okay to invest in a strategy like this, which the fund manager is following.
Absolutely. You should analyze NAVs. I think everybody should have a data about how NAVs have done in the past. And I think if you go online, there are plenty of websites today which will give you all this data for free.
So let me ask you this question. So let us say you're a young 25-year-old person and you're ready to take as much risk as possible. You're ready to take as much drawdowns also as possible. Your entire objective is capital appreciation in mutual funds.
Yeah.
And you said, don't look at the funds, look at the fund managers. So most of us only know the fund names, like Axis Mutual Fund, Kotak Mutual Fund. We don't really know the names of the people behind these funds. So for someone like you who is in this industry, any names that you really like and people should follow, who you think are really doing some phenomenal work, making good returns and taking some kind of risk as well?
My mentor, Mr. Parag Parekh, his psychology has been very, very deep rooted into the fund he has.
Yeah.
Okay. So if you're looking for a very balanced fund, I think Parag Parekh fund is one of those funds where, very, very brilliant minds managing it. And then HDFC Securities back in 2007, sometimes fund managers also lose their way over time. That is something that you have to track very actively. But I think HDFC Securities was that time in 2007-8 when I started a very, very good fund, which I was really, really impressed by. Then I believe somewhere Quant MF is doing pretty well. Has brought something new to the table for the mutual fund industry. And then personally for younger investors, I would say look at the funds and fund managers who are trying to focus out of the top 200 companies out there. Yeah. So if you wanted to invest in the top 200 companies, if you want to buy a Reliance or a Tata Motors or a TCS, you can do it yourself. You don't need to pay me for it. Yeah, it's very, very simple. Tell me which is the best automobile companies. We all know, that Mahindra cars are coming up really well and stuff like that. So now when it comes to who's thinking out of the box. So listen to interviews from time to time, look at episodes like yourself where people are talking newer things, and then try to catch in with them.
Got it. So maybe now we can talk about, currently in the 1% Club, we have 150 employees. And what we are noticing is that maybe 6 months back, the rate at which we were hiring new people is gone considerably lower right now. Because what we have identified is that with the advent of AI and with the kind of operational efficiencies we're able to do with AI, the same number of people are able to do more work than before.
Absolutely.
So even though the requirements are increasing of the business, we are able to get it done through the same number of people. So the number of job openings have dramatically reduced from my company. And I was speaking to my HR and she was telling me that even in other companies, the number of job openings have dramatically reduced. Not just companies of my size, but even larger companies like Google, Facebook, openings are lesser. But the number of graduates that India is adding is the same, if not increasing, right? More and more people are entering the job market. So if there's not enough jobs being created, and if the number of people looking for jobs will be more, don't you think somewhere or the other, the economy is going to suffer? Because there's not going to be enough people, not going to be enough jobs for people to get. And if that happens, consumption will drop. If consumption drops, companies will suffer. And if companies suffer, they'll have to lay off more people. So that could result in a ripple effect. So my thesis is that the market for the middle class segment, the businesses which are focusing on the middle class companies or middle class people will eventually become smaller and smaller because middle class is shrinking in India. And the companies which are focusing on luxury items, those will benefit really well because the rich will get richer. That's just my thesis, but wanted to get your thoughts on how you're thinking.
See, you're right when you think that, but somewhere I have a different view. Let's talk about the stock market to give an example. The stock market size when dematerialization happened back in 1994 was this small. I think 10,000 crores or something. Today we are at massive volumes. Why? Because anything that happens makes your cakes larger. This AI which is coming into will create new jobs. Of course, there'll be fractions. Of course, you'll have to work more hard to see how AI to walk with AI, what new jobs need to be introduced. But ultimately, as the computers did back in 2000s, the AI revolution will do for the next few years. Okay. Overall, businesses would grow. And when companies, they make better profits, ultimately, they will somewhere increase the salaries of their employees as well.
Cool. So now let's get to the rapid fire round.
Okay.
Right. First question. The first stock you ever bought, did you make money or lose money in it?
I made money.
You made money? Which was it?
Unitech.
How much did you make?
I think 1.5x.
Okay. Yeah. Second question. One sector you believe is super underrated right now?
If you talk from INVasset point of view, I told you about the sectors already, but there is a lot of scope in defense in India.
Defense is underrated still?
I still believe so.
Okay. Parag Parikh says one lesson that changed your thinking forever.
Respect money. Capital is the only real thing that you have. If you lose the capital, you will be left with nothing.
So capital preservation.
Yes.
If you could only use one data point before investing, what would it be?
Only one. I think it will be growth.
Biggest red flag when you're analyzing a company?
Management.
What's one investing myth you wish more people would stop believing?
I think people fall a lot into value traps. If something has fallen 40%, everybody ventures into it without understanding, is there earnings visibility for the next couple of years or not?
Got it. So value trap.
Yeah.
Which book do you recommend to every young investor?
For me, it is One Upon Wall Street.
Value, growth, quality or safety? Which stage do you enjoy the most?
Growth.
Finish this sentence. In investing, the biggest edge is?
Experience.
Cool, Anirudh. That brings us to the end of the podcast.
Thanks.
I think this was a phenomenal conversation. I hope you enjoyed it and you were able to, share things in a manner that you wanted to share.
Absolutely.
Yeah.
Thank you so much.
Yeah. Thank you so much, Anirudh.